The people in front of you are our best partners in the stop-loss business. Many of you who are clients are covered under a program or a plan that one of these people writes, no doubt. But there's a lot going on in the stop-loss business. Last year we had a similar panel. In fact, almost everyone was on the panel, and we got a lot of comments about that it was a really good session, but it wasn't long enough. So we elongated it, or we're hoping to elongate it. We'll go as long as we need to, as long as it doesn't go past the cocktail reception, right, or to the beginning of the cocktail reception. But let me introduce the people who are sitting on the panel here. Steve Butts from IMG Stop Loss. You could just wave or something, I don't know. From IHC, Pete Doran. There's Pete. HM Insurance, Beata Mady, who apparently just got off an airplane and walked into this room right this very minute, which is great. Rob Frischman from Optum Health. Jonathan Socko from East Coast Underwriters. Chris Cooper, Montgomery Management. And last but not least, Kurt Ritter from Spectrum Underwriting Managers, who also just got off a plane and came here. So thank you all for doing it. All right, here's the deal with this whole thing. We don't necessarily have any kind of format for this whole thing. What I'm really hoping is that we can have an interactive discussion, answer your questions, kind of start talking about what your experience is with stop loss and in our industry and the things that are going on. And so I've got a couple of questions, but again, raise your hand. Holly's going to run over to you, and you can use the microphone and all of that. So I asked everyone to send me some questions that they would like me to ask, and turns out Steve and Beata were the only ones who sent me anything. So and then Jonathan did later after I scolded him. So I'm gonna only ask Steve and Jonathan Beata questions. So from now on, but no, I'm not really. All right. So here's probably the most obvious question, and maybe all of you can kind of address this at this point. But I'm interested to hear from you what you think has changed for you and your industry over the last 5 years or 10 years, or even 2 years. What's new? What's different? How is it different than it used to be? Steve, you want to start down on your end?
Well, what hasn't changed? Obviously, with healthcare reform, there is just a growing knowledge, I would say, within the broker community and the TPA community relative to self-funding in general. So the questions that we get asked and the things that people are getting more creative. TPAs are bringing more initiatives to the table relative to cost management, and so just the relative knowledge in the marketplace about self-funding and cost management and claim management initiatives, I would say, is one of the biggest changes.
I would say for us, broker education on self-funding, travel the country and talk to broker seminars with our TPA partners about the viability of self-funding over fully insured, and just a tremendous amount of enthusiasm and brokers willing to educate themselves on the changing environment, and a ton of groups that are currently fully insured getting the superior environment that is self-funding. It's just the fully insured to self-funding business has been probably our fastest growing sector.
Yep.
Chris Cooper, Montgomery Management. I think the threshold which employers are looking at the employees, I guess what I want to say, the number of employees that an employer has, that threshold has dropped tremendously since the ACA. And Tom, I think we should probably go this way, and then so that there'll be answers for both ends of the table on the questions.
Okay, that's cool. Whatever way you want to do it.
Well, that's exactly what I was going to say. But what I'm seeing, I'm in Minneapolis, is where I'm based out of. But self-funding is getting much more of an audience these days, which a lot of you are on the front line. You're seeing the same things that I'm seeing. But what I'm seeing too is, as Chris just mentioned too, is that the minimum lives has been dropping dramatically. I've seen some of the carriers in my neck of the woods go down to, I believe, 10 and 12 lives for self-funding. And everybody's going to have their own opinion if that's a good idea or not, but I think it's evidence of that self-funding is going to be a lot more on the radar screen than it might have been in the past.
Yeah, I'm going to kind of dovetail off what these guys said. I mean, it's groups that you almost would have never thought self-funding years ago, smaller employer groups, just kind of opening their eyes to the advantages of self-funding, things like that. I think that they pretty much said it perfectly.
I would echo what my friends are saying, but one thing that is interesting, there's a lot of interest in the small group market, probably more interest than actual buying right now, and I think some of it is because of delay in mandates. One thing that is dangerous, though, there's a lot of interest, but I'm not sure if the knowledge of the broker community have increased. So I think somebody from the beginning said something about, concentrating on broker education, and I think that's absolutely a key, because, with the fully funded type programs that people are offering, one would ask whether the clients are aware that they are self-funded, because they look and feel like fully insured. So the broker education is a must. We also see a lot of interest in high deductible. Companies that used to go naked now need stop loss. So $1 million, $2 million deductibles are not a household name, but definitely more interest.
Well, first, we're all breaking the cardinal rule of conference speaking, and that is never follow Adam Russo. It's like following James Brown. But I would echo what they said about small group stop loss being much more in focus now, but with that comes some danger, and I see the danger at the state level because of the attention that small group stop loss is garnering from state regulators, from insurance commissioners and such. So I think by virtue of the fact that we are a better mousetrap, that self-funding for small employers is the best mousetrap out there, it's going to draw more attention from the states, establishing higher minimum specifics, minimum ag retentions, things of that nature, maybe states like Colorado that have outlawed lasering, things of that nature. So that's where I think some big changes have come and are coming.
And, all right, I'm going to go back to Steve for a second, because when in a preliminary conversation about this several weeks ago, Steve brought up an interesting point, and I wrote it down actually, that he said that the majority of my marketing effort these days involves addressing the risk or the perceived risk of self-funding, and so that what ensued was kind of a conversation about risk in its various iterations. And so, Steve, if you can kind of give us your idea of it, and of one specific issue. What kind of risk? I mean, how do you address the risk of to the plan at renewal when there's an ongoing claim? And how do you mitigate that? How do you deal with it? And how do these people who are either brokers or clients kind of deal with that?
I think one of the biggest issues to the self-funded employer is what happens at renewal. And obviously, if you have a year in which nobody gets sick, you don't have a lot to worry about. And it's the worst case scenario if you have not only have you had somebody sick with a significant claim situation, but that happens to be ongoing at renewal. What is the stop loss carrier going to do with that ongoing risk, and what are you as the employer going to do to manage that risk? So our industry, the stop loss industry, has really developed a lot of different approaches, and Adam, in his illustration of the no risk versus all the risk difference between those two employers, and somebody's willing to take more risk, the answer to that question, what do you do, is really up to you. Our industry has options that include a stop loss policy that guarantees not to laser at renewal that individual with the ongoing claim, and maybe even in this audience we ought to define what a laser is. A laser is the shifting of the risk of an ongoing catastrophic claim from the stop loss carrier to the employer. So the cost of your premium obviously is associated with the risk, and if the stop loss carrier is going to take all of the risk for that ongoing claim, then the premium is going to be much higher. If the employer is willing to take some of that risk for that ongoing claim by purchasing a higher specific deductible on that individual, then obviously your premium is lower. So the important thing to take out of that is that our industry has both products available. We have a product that gives us the opportunity to laser out that risk and lower your premium, or we have product that guarantees that we will assume all of that risk, and those products even have, to some degree, a maximum rate increase guarantee that goes with them. So we have options for handling that risk at renewal of the ongoing claim.
Okay, just for future reference, if we can put the microphone closer to our mouth, I'd appreciate it. Audience poll, who thinks lasers are a good thing? Or show of hands. How come everyone's not raising their hands? Pete, why are lasers a good thing, or are they?
Well, I first want to say something real quick. You know, the reason that you partner with Cypress is, you know, even prior to the laser being set, you know, we have the opportunity as a stop-loss carrier to get the pre-search, we have the opportunity as a stop-loss carrier to get pre-search, trigger, all the data and real-time information, and the quicker the stop, and I think everybody would concur here, the quicker we get that data, the quicker our nurses and doctors can work with Cypress and work with you folks to get the person in the right facility, negotiate the right discounts, and all those good things to help keep your claim costs lower. And what's your question? Why is laser
you lost the question. I'm going to ask Beata now. Beata, laser is a good thing or a bad thing?
A bad thing. I'm a carrier, and I would rather just take the risk. The lasers are an invention of a brokerage community. You know, everybody wants to be competitive in the market. So first there's the most competitive rates, and at the end, you know, somebody decides they're going to eliminate the liability by lasering people. I would rather charge extra money and just take everybody. I think we're putting ourselves as an industry in danger because health insurance cannot laser anybody, but we can. And even though, you know, a lot of the ACA rules do not apply to stop loss, but, you know, if you create gaps in coverage by not offering what the ACA requires you guys to do, then that's a problem for everybody. So we as a carrier would rather that we charge extra and take all the liability in there.
Chris, you agree or disagree?
What I would say, that sounded loud. What I'd say to that is I've been in this business about 30 years, 1984. And when I first was in this business, that word didn't exist, or at least in this industry. It was in the early 90s that became, and I would agree with my person down here, that the brokerage community was looking for a way to give the employer options to be creative at renewal and keep the cost down. Because as we all know, if you have a diagnosis, it's not always going to be exactly what the projected costs are going to be. So instead of just charging that premium and having to go back and rectify that with the employer, giving the employer the option to maybe only pay that if it happens is what really drove the lasers.
Yeah, my own comment on this. A couple of years ago, a number of years ago now, we did a study on our lasers. We had a number of our clients who had a laser on one or a number of people. And we took a look at every single lasered individual and watched to see what happened during that plan year. And do you know that less than 50% of the people even hit the normal specific deductible, and almost none of them went over their laser? Why is that? Many of them were lasered simply because they had incurred huge expenses the year before, and then they were all done with their treatment. Some of them died, which they're obviously not going to hit their laser. But in the event that there was a no laser policy on that, the potential, I think, is there for a client to pay more in premium than they necessarily should. I think you can have a debate on lasers. I can go either way. No. Again, I'm supportive of lasers. I think they are a tool for cash and management. But I think it's really up to everyone individually as to whether or not it makes sense.
And Tom, I think it's worth mentioning, I think all the carriers up here offer no laser options or guarantees of no laser with some kind of premium versus maximum rate liability.
Yep, I would agree. All right, Rob, I got a question for you. What kinds of problems or mistakes, what are the biggest mistakes that you see as a large carrier that people like us in this room are making when we place business with you, initially and then renewing a case? What kind of mistakes are brokers making? What kind of mistakes are TPAs making out there?
I think there's a couple that come to mind. Is that if you look at what the cost of the self-funded plan is, a lot of employer groups and brokers might look at it and say, well, it's the maximum cost. And they'll set their COBRA rates on the aggregate factors plus your fixed costs. And that certainly is the maximum, but I think that if you look at that's the true cost of the plan, it's not. Secondly, if you're looking at these groups rolling, at least we're trying to get them to roll from fully insured to self-funded, you look at these groups and look at the bottom line and say, what's the aggregate factors plus the premium? That's the cost of the plan, or that will be the cost of the plan. And it's not. Obviously, that's the maximum, but the true cost of the plan is going to be quite a bit less than that. And I just want to add one thing on the lasers, if I can, Mr. Doney?
Yeah, sure,
okay.
sure.
The example I give people regarding are lasers good or bad, and this is something, a real life situation that happened a couple of years ago, where it was one of those renewals, if a group is running fine, comes up on renewal, and there was 2 ongoing claims. And we gave that employer the choice of 2 lasers or the premium kind of offset. And the way I look at the premium is you say it's the 12 easy payment plan for the amount of the lasers. And they chose the premium plan. 2 months into the plan year, both those people passed away. And I got a call from the broker, hey, can we get that laser option? The answer was, sorry, that's, you can't. So in that situation, as Tom was just saying, and that's with our book of business, probably a lot of the people up here, is that the times that you're going to hit the actual laser are far shy of 50%. So you can't look at those, and this is kind of dovetails into your actual question to me, since, sorry, I'm diverging a little bit, but you can't look at the actual cost to the renewal of your fixed cost or your premium plus your laser, because I think you should stagger it and say, okay, here's without the laser, here's the renewal with, let's say, half going to the laser and then maxing out your laser. Because, again, the nurses that are on staff and a lot of these people up here, including us, a lot of it is a guessing game. We get information in saying this person's in hospice, probably is not going to make it, and they live for another 20 years, or they're fine, and then they're a train wreck. So it is extremely difficult to predict what's going to happen with these large ongoing claims, or potentially ongoing claims.
All right, now you abdicated your ability to answer my question, so I'm going to go to Jonathan. What comes to mind in terms of mistakes that people make when they're placing business, and how do we avoid that?
I think the biggest thing is maybe not being 100% educated on how stop loss works from a pricing standpoint right up front. And I think somebody else said looking at your maximum cost versus what the premium is and the attachment point. I feel like a lot of people tend to focus on, oh, what's the bottom line? What's the bottom line? Can we take the ag corridor down? Can I get a 120? When we're partnering with TPAs like Cypress, we're really trying to look at that ag number, but also say, hey, we want to come in well below the ag, the attachment point's the attachment point, but those are all soft dollars. That's not a guarantee. We look at our loss ratios with Cypress, and it's probably the best with any TPA we work with, and it's because they put those measures in the plan up front, whether it's wellness programs, cost containment, those kinds of things. So it's really important to take all that into account up front and just realizing what you're going to be spending your money on from an ag standpoint versus the overall bottom line.
All right, Kurt, you have any comment on that? Or any additional things?
It's probably mostly related to, boy, everybody gets tired of stop-loss carriers saying this, but our products are often treated like a commodity, and they're not a commodity. There's a lot of differences between what we all offer up here. I'd like to think what I have is the best, and everyone would say that very same thing. So I think that as buyers and as brokers that are placing the coverages, you really need to be aware, as Adam said prior, that there are differences in the contracts. They do cover different things. They do apply different sets of standards. The underwriting processes we all follow are probably relatively simple and the same, but the way the contracts apply are different, so you need to be aware of what you're buying.
All right, and speaking of mistakes and mistakes in claims, is there anything that you consistently see out there that are mistakes or problems when people are submitting claims that is going to cause a denial?
I do. Buying stop-loss coverage with gaps in coverage. We see it more often than not. Policyholder buying a policy maximum. Stop-loss does not have to follow the ACA when it comes to policy maximum, and we actually require brokers for 2014 and beyond to sign off with their client that they understand that their policy, stop-loss policy, have a maximum. And as you know it, claim comes up and it's above the maximum, and we get this dreaded phone call. Could you make an exception because we did not buy more than $2 million, and it's going to be a $3.5 million claim. So that's one of the problems that we are seeing more now than before. And 2014 was just around the corner. So I think as claims become larger problem for everybody, I think we're going to see a lot more if clients decide to continue to move in that direction. Another one is clients moving from fully insured to self-funded and buying a 12-12 product. Speaking of commodity, it's easy to sell. It's much cheaper than fully insured. But if you don't sell them or if they're not buying run-out protection, you're going to have a problem, because if they decide to go back fully insured at one point or another, that's going to create a problem and a potential E&O claim for the ones that sold them. And another one would be for the stop loss product not to mirror your plan document. We've seen a lot of exclusions out there when we compare quotes. It appears everybody's competitive until you start looking under the table, if you will, and you see that the contracts, stop loss contracts, are not necessarily compatible. And if there are exclusions that dispute what the plan document would pay, it's a surprise for somebody when the large claim comes up.
Did I hear you say that you're going to require that the broker sign off on the disclosure form or on something that indicates that they understand the plan document, or the client understands the plan document, or any gaps in coverage?
Yeah, they understand that there is a policy maximum. That's the only time we're going to require people to sign off. If a client, as of January 2014 and beyond, wants to have a $2 million maximum, we require the broker to get a signature from the client that says, I understand that this stop loss policy have a maximum, even though my plan document does not.
What do you guys think of that? Guys with red bands on. Are you okay with that? Yep. Everybody's cool with that?
I don't want to beat that horse, but I have a
Oh,
comment
no,
on
I'm
I
just
have a comment on the lasers. We just can't let it go, I guess. We just did a study on our laser policies, and we have a $770 million block of business. I like to think that it's pretty credible. And actually, we found out that all the laser accounts run 20 points worse than none. And when we peel the onion to see if it was just the account being populated with other claimants, no, it's the lasers. So somebody made a comment that they may or may not happen. And actually, Tom, you were very generous with 50% accuracy rate. But when they do, they hit big.
You got anybody seen a $5 million claim yet? Anybody have one? Nothing? All right. It's coming.
Oh, yeah.
It's coming. I have a question. It's based on what Beata just said, but a question on what's your take on 12-12 contracts when you're coming from fully insured to self-funded, and do you have to protect yourself on the back end? And I ask the question because we tell people all the time, and we probably have said this to most of you in this room, if you're going from fully insured to self-funding, you become self-funded for a reason. It's because you should want to have control over your health plan, and this is not a one-year thing. And so I'm okay with 12-12 contracts, but I'm wondering, what do you think about what you need to do about that, and do you like them or not?
I don't have a problem with 12-12s. She made the point that a lot of times the pricing versus the fully insured policy previous year, it's going to be much more competitive. You're probably looking anywhere in the area, case by case basis, obviously, anywhere from 10 to 30 points below fully insured, just if we're using our base manuals and not getting crazy. But I think they're a good way to get the group over to self-funding, as long as we're doing the education up front, telling them that there's essentially going to be a cost adjustment to a paid the following year. That's critical. And I can't tell you how many times that folks don't understand that there is going to be a cost adjustment, and on top of trend and claims after the first year, it's not exactly fun to explain to a broker that's maybe more savvy in the fully insured realm that there is going to be a cost adjustment just based on that. I think that's the biggest thing, but I think a 12-12 can be a good option. May or may not need to buy TLO, but I'm usually a fan of it. So,
anyone else? Oh, we have a question from the audience. I wish I had a $25 chip to give you just for asking that question. All right, wait, now you got to wait for Holly to come up with the microphone.
So when you talk about a 12-12 contract, I mean, is there a difference then in relation to a group coming from a fully insured market that has no data and is not going to fill out any health applications, anything like that? I mean, truly, almost going into this for the first time, do we want to lock a longer contract without that information, or talk about getting them into self-funding with a 12-12, get some, efficient data, look at some information, and then put them on the appropriate contract after? I mean, does that thought at all come into it?
I think it does. It's going to depend on the size of the case. If there's no claims data, absolutely, at all, if it's below, 80, 75 lives, and I think I submitted a question to Tom, so we may hit on this in the future, but I'm a big fan of individual medical applications. I mean, if you've got a 50-life case, no data, not getting anything from the Blues, I think it's critical that we're allowed to underwrite that appropriately, and that way that there's no surprises year two, and it's not a fun conversation either to have after the first year. Well, we didn't underwrite. There was a huge claim out there that we didn't know about it. We wrote the case anyways, and you have to have a tough conversation about the increase. But I think, Drew, you made a really good point, and I don't know. I just like 12-12s.
Right. So, Steve, because you write a lot of the smaller size cases relative to other stop loss carriers. What's your take on that?
Well, my take has always been that the cost for the 12-12 contract. I'm with you, Tom. It is a long-term decision. It's a more than 1 year decision to be self-funded. So, I'm old school. I believe in the 12-12 first year if you're coming out of fully insured, and renewing that contract to a paid contract in subsequent years. That way there's no gap in coverage. So it's just important to distinguish, when we're talking about 12-12 contracts, the only time a 12-12 contract should be used is in the first year, converting from fully insured to self-funded.
And then when you renew from a 12-12 to something else, what should you do?
You should renew to a paid contract, and that should be a 24-12 contract, not a 15-12 contract, because if you renew 12-12 to 15-12, you still have the chance for a claim to fall through a gap. So the ideal gapless renewal from a 12-12 is to a full paid contract, and then each subsequent renewal ought to be a paid to the inception of the first year. So the third year is a 36-12, the fourth year a 48-12, and so on. You asked what mistakes we see in the marketplace.
Yeah.
That's one of the biggest ones. We see all the time people requesting for currently self-funded business a 12-12 option at renewal. And just being in this business as long as I've been in this business, I would never recommend, I don't care how small the group, I don't care how much the employer thinks he knows about what claims may be out there or may not be out there, I would never recommend renewing a 12-12 contract to another 12-12 contract.
Rob, did you have a comment on that?
Yeah, I just want to add two things. One is I'm a 12-12 believer in the first year rolling from fully insured to self-funded. Two reasons. If you want to have some kind of incurred or fully insured lookalike stop-loss contract, be it 12-15, 12-18, 12-24, obviously if you're going from 12-15 to 12-15 or 12-18 to 12-18, there's going to be a gap in coverage for those claims that are not paid in that additional 3 months of the plan year or 6 months. So you almost really want to do a 12-24. Year in and year out. If you really want to have that fully insured, you can easily go back to fully insured if you'd like. But it seems like a lot of the employer groups want to have a plan that is budgetable and they know what the cost is very shortly after your year is over. If you have an incurred type of contract, let's say your January to December year is over, you don't know what the cost of that plan is until 12 months after that. So typically employer groups want to be on a paid contract so they know a day after the year is over, what might cost, how do we do against the budget?